alaikum. Welcome to Candid Talks. Today we have with us Binod Razin. Binod is the co-founder of Monks. He has been in technology-based businesses for over 30 years and had very successful Silicon Valley startups and exits. Recently, he started a very successful services-based company, which he grew in multiples of over 3.5 years and sold it to Sir Martin Sorrell. And now he is the co-founder of Monks. Welcome, Bedon.
Assalamu alaikum. Thank you for having me here today.
Yeah, thank you for being here. Please share with us about your journey, where you started and where you are now.
Sure. So, as you had said earlier, I started in several Silicon Valley startups. I was born and raised in Chicago and was in sales for those startups. So they were headquartered in San Francisco or San Jose area, and uh, and I represented them in the Midwest. Grew the presence, signed some large customers for them, and worked my way up those organizations. We had some successful exits that were part of the journey. That was fantastic. And then I went ahead and joined Oracle after a few of those for a couple of years. It was great at Oracle, but the culture wasn't necessarily for me. So I worked in private equity after that for one of the CEOs that I'd originally worked for earlier in my career, who had gone into private equity. We had two successful exits there. It was a very exciting time. And then some of the folks from Oracle convinced me to join a fledgling business that was growing inside of Adobe called the Marketing Cloud. And so this was in 2011, 2012. And so I joined the small business, or what was relatively small at the time. And the stock at Adobe was $22. I left Adobe in 2018. The stock was trading at around $280, $290. So we more than 10x the stock while we were there. And it was really a fast-growing business. Now the Marketing Cloud at Adobe, or now what's called the Experience Cloud, is the ubiquitous cloud in the spaces that it operates in. But I left to go pursue my entrepreneurial path. I started a company called Maverick Digital. It was a Salesforce services company mostly. So we had a very niche focus in the company. One of the principles that I'll talk about later on today when you want to build a services company. And we grew extremely fast, extremely profitably. And I would get these phone calls from folks that wanted to buy the company. And I just wanted to grow it, didn't necessarily want to sell the company. But then I got a call from one of the folks that worked for a legend in the advertising industry. For those who are familiar, Sir Martin Sorrell started WPP and then started, which is the world's largest advertising holding company, and then started S4 Capital, which operates under now the Monks brand. And so I got a call from them saying, hey, we want to buy your company. And after several negotiations and discussions, I sold the company to Monks, and which was a very strategic and wonderful exit. And now I'm a co-founder at Monks, running a large portion of the Salesforce practice globally.
Okay. Can you share a little bit about Monks? What type of services they provide and which countries they are operating?
Yeah, so Monks operates globally. It's based out of London in the United Kingdom, but we do have offices all over the world, from Asia Pacific to the Middle East, North and South America, all over Europe. And the type of services that Monks delivers really spans across two different pillars. One is marketing services. So think of anything that a large brand would need related to marketing services, everything from data, digital, creative, content, everything that you need to run a marketing organization, and then technology services. And this is where we really find our home with the CIO or the CTO and really build out the tech services and the tech stack and a lot of bespoke technology solutions that companies need.
Okay, all right. So you have been in like over 30 years. You have been in the technology segment, both on the service side and on the SaaS side. Which side do you like better?
It's a great question. I have an affinity for both. They both have their pluses and their minuses, and I actually think there's a lot that I learned on the SaaS side of the business that applied on the services side of the world, and vice versa, where I think the financial discipline that you really need to have on the services side of the business, where you have to run a profitable business, you have to look at different indicators in the business, apply on the SaaS side, where a lot of folks think you build a product, go get some venture capital, and it just explode in terms of growth. But there's so few startups and companies that go through that explosive growth and do it successfully in the venture capital model. So if you can apply a lot of the principles from the services side of the business to the SaaS business, you could actually, especially in today's economic environment where we're past zero interest rate policy, and that's no longer the case in the economy. You actually have to make money in some of these businesses or in all of these businesses. So I
Mhm.
think it's really good that applies there. So I like both businesses, but I definitely appreciate and value the growth and scalability that's associated with SaaS businesses. It can be pretty tremendous if you
Okay.
find the right product and scale it properly.
Okay. So let's just start the conversations with the SaaS product. And
Great.
in developing a SaaS product, what are the critical factors that you have to consider before you jump on it?
Yeah, I think you have to have a strong vision for what the product's going to do initially. And that vision, I always use the saying, I invest also in several SaaS companies. And when I talk to the founders of these companies, I tell them, if Henry Ford, he used to always say, if I asked my customers what they wanted and built that, I would have built a faster
Mhm.
horse
Yep.
and instead of building an automobile. And so I think as a founder, you have to know your space well enough to where you
Mhm.
could build that automobile for the market. And then once you show that product to a few of key people that would use it or key companies that would use it, you want to incorporate their feedback. But I think at that point, you will have changed their perspective and changed their mindset, to use that analogy of the car and the faster horse, that you're building a car now and they understand what a car is. So you're building a disruptive technology that's going to take out the existing way of doing things. And it's not just an incremental change, but it's actually a disruptive change. And once they understand that and they agree with that disruptive change, you want to incorporate the feedback into the product as quickly as you can, so it can be used day to day by the clients and the markets that you want to serve. And that whole process is called finding product market fit, or PMF is what a lot of folks call it. And it's not a moment in time, but you really have to anneal your product to the market and really bang the product against the market to make sure that it addresses the detailed needs associated with the market and delivers the business value that you originally set out for it to deliver.
Okay. Can you share with us an example of one of the companies that you established and how you went to identify the product market fit?
Yeah, that's a great question. There's one company I invested in. It's called Automato AI. And what they do is they use AI to build your Amazon listing. So they take several data points including your competition, including keywords that are being used on Amazon. It's over 10,000 data points that they take into consideration, and then they build the listing for Amazon. And historically, the way that was done, and the founder of this company is a gentleman by the name of Abdul Khan, and a couple of other folks, Rami O'Day and Peyton Hoyta. But they went out and built a company around that vision. And they were e-commerce guys, so they really understood the e-commerce space, and they really understood Amazon. They had a great history around building businesses on Amazon, and they knew how to disrupt how things are being done on Amazon. So if you look at how products are being listed on Amazon today, if you have 5 or 10,000 products on Amazon today, you have a team of copywriters that are essentially typing out that listing, or you hire an agency who has a team of copywriters that are typing out that listing. That listing isn't being updated. That listing isn't being optimized. That listing isn't being taking into consideration the competition and what the competition is doing with their products. Like if a competition drops their price by $10, that's going to have impact on your sales on Amazon. These people, what they did is said, we're going to disrupt that model. One, we're going to optimize the listing for all these different touch points so the customers sell more. It's so disruptive. One of their customers is actually sold year over year 57% more than they did the previous year. So imagine that, about 60% more or 60% increase in sales by using AI to build your listing. That is disruptive. That is not a faster horse. That is the automobile. The other part that's really valuable that they deliver is they are able to now do more with less. And this is more evolution, but essentially what they're able to do is now if you have a team of 10 copywriters, it's 3, right? So because AI is building the listing, the copywriters are checking the work that the AI did, so you may need 3, but they're certainly not building out the entire listing, so you don't need 10. And that's a huge value for customers as well. The way so they originally had this vision, right? And they knew the value that was going to be delivered. But then what they did was, frankly, they went in and used their relationships in the marketplace to go get a few customers that paid for the product. Because even if they pay a little bit for the product, it's better than giving it away for free. Because if you give something away for free, customers a lot of times will not hold value to that product. But if they're paying for it, even if it's a little bit, they will attribute value to it, right? It's a human nature thing. So they went out and got customers. They listened to those customers. They asked some really good questions of those customers around their usage and the value that they delivered, like some of the metrics that I just gave you around the value they delivered to their customers came from the questions that they asked their customers. And then they are starting to get the curve of the hockey stick right now, and in terms of their growth, and they're doing fantastic. So I think they've, found some product market fit without question. I think they're still on that path. But as they find that path, they're also going to accelerate sales significantly and grow the company, very fast.
Okay. You talked about some of the pricing models over there. Can you elaborate on it when a SaaS company is starting? What type of pricing models you suggest they have? And over a period of time, what would be that period of time where they get to a point where they charge the market price?
Yeah. So first off, software in SaaS is highly elastic. And depending on when you buy and how much you buy really determines what you pay in SaaS. As we all know, the large software companies have trained customers to buy at the end of the quarter or at the end of the month so that you get a great price. And so it is very elastic. But there are certain principles and certain models that you should stick to as you're building out your company. One, always charge for the software, never give it away. I think that's absolutely critical. Two, price your software based on what the market um, needs for that particular piece of software. So let me explain what that means. Uh, if you price all your software per user, that may not be the appropriate way to price your software, right? Something like Microsoft Office or Outlook or other desktop tools might be great to price per user because it just makes sense to do that. Every person that uses the license, you charge them for it. But something like an Automato, which is a new type of software, it's AI, and it doesn't make sense to price per user. Candidly, for Automato, they price per ASIN or per SKU on Amazon, right? So the more scale you add, the more expensive it gets, and the more value that you get. And so you really want to price based on that. The third is have a custom pricing model that makes sense for your market. And then third is you really want to, people always ask, how much should I charge for my software? It really depends on what value you've established in the transaction. And that's why early on I said pricing is very elastic. If you've established a significant amount of value in what your software does for that specific client, and it's hard value, and you've even built out an ROI that's associated with it, with that customer, that the customer or prospect has bought into and owns with you, then you could charge a lot more for your software than if you're just selling a bunch of features and a bunch of technical capabilities of the product, and then asking the customer to go buy it because it's really cool software and it's really amazing, right? So you really have to tie it and ground it in a financial ROI and then price it based on that.
Okay, so many SaaS products that we see right now, or like in the past, what I've seen in a few years, they come up with a version that is free, and
Mm-hmm.
then they add features to that, and for those features, they charge a certain amount. So, are you
Yeah.
suggesting that there should not be a free version of a software, and for every functionality that you are providing, it should be based on value that you are adding, and that's how you should be charging?
Another fantastic question, Kashif. So if you look at the entirety of whatever you're building,
Mm-hmm.
that should be charged for, right? But if
Yep.
the freemium model is great for lead gen, right, and for growing and
Uh-huh.
accelerating into customers with a low, potentially low customer acquisition cost. And
Mm-hmm.
so, if you have a product that lends itself to a freemium model, uh, that's certainly a path that you wanna take, and it's a good path. But don't give away the entire suite for free, right? Like, so
Okay.
if
Mm-hmm.
you've got a stepping, you've got the basic and maybe an intermediate and then a premium version of that product.
Mm-hmm.
Just because you want to get customers using the product, don't give away the premium version for free. But if you have a
Okay.
basic version that seeds the market, develop leads for you, and allows you to grow, that certainly is a path that you want to explore.
Okay. All right. So take the freemium version just as like a lead gen approach.
Yeah, it's great for lead gen.
Yeah.
Absolutely.
All right. Sounds good. How do you you did talk about engaging with the customers and getting their feedback and all that in terms of product development, product enhancement as well. From customer retention perspective, when it comes to SaaS product, there is very little interaction that you have compared to a service-based company. How do
Hmm.
you retain customers in SaaS-based product and have the engagement with them, have a relationship with them?
Yeah. So The first thing is you have to look at hiring and bringing on a customer service manager or two in the early days as part of the company. And in the early days, that CSM would be tied into development, not into sales. And so you'll want them to be able to get that feedback from the customer and put that into product development right away. So product development could prioritize the features or the enhancements that are coming from customer success into the product. So that's one way that you continuously engage with the client
Mm-hmm.
and get their feedback on how the product is doing is by doing customer success. But the other thing that I like to say in the companies that I invest in is everybody's in sales and everybody's in customer success. Those two departments, everyone in the company, including the CEO, should be in those departments. So if you're selling, you're probably closest to the customer and have a lot of feedback as to objections as to why the clients or the prospects may or may not buy the products. And
Mm-hmm.
then as CSM, you're also very close to the customer and you're understanding why customers are buying the product and staying with it and renewing their licenses. So that's the CSM is certainly one way. The other is in a lot of SaaS products, you actually don't see the value right away. There's an implementation time period, there's an adoption time period, especially with disruptive technologies. There's change that has to take place at the customer, whether that's a process change, whether that's a people change, beyond the technology, for them to adopt and gain value of the technology the way that it was intended to be used. And so that may take 3 months or 6 months. So another thing is you really want to sign customers when you do the deal to a long-term SaaS contract, whether that's 2 years or 3 years, so that they have time to really adopt the technology and lock in the price that they're buying the technology for. So there's some advantage for the customer in that they maintain the price at a steady level throughout the life of the contract. As we all know, renewals come with an uplift, and there's no
Mm-hmm.
renewal if they sign a 2-year or 3-year contract during that period of time. So there's value to the customer, but the value also to you is the customer's locked into a contract. So they're going to go through the cultural change to adopt the technology and have the time to do that versus a
Mm-hmm.
month-to-month subscription where after 3 months they realize that this may be very painful for their organization to adopt, and they decide not to do it because they've lost sight of the value that's associated with the technology.
All right. So can you talk more about because mostly I see on the SaaS product side or the experience that I have, they are more on month to month, or at least they start with like a 3 month contract, and then after that
Mm-hmm.
it turns into month to month. So you are
Mm-hmm.
suggesting that SaaS based companies should be uh, getting customers for more like a 2 to 3 year term, especially in the starting phase, because customers are gonna go through the struggles that these SaaS companies are going through as well in their growth, so they stick around.
That's correct. And in large enterprise, like if you're selling to large enterprise, it's
Mm-hmm.
standard to have a 3-year contract. And so you may negotiate that down to 2 if the customer requires a 2-year contract or their budgeting doesn't allow them to lock in things, for 3 years. You may negotiate that down to 2, but in large enterprise, it's pretty standard
Mm-hmm.
to do a 3-year contract. Now, I have noticed in some markets in the SMB, small and medium-sized business, uh, that they want either month to month or maybe annual contracts. But I think if you explain to the client the value of going multi-year associated with the pricing,
Mm-hmm.
they may, not every time, but they may go with a 2-year contract instead of a 1-year contract. But minimum, you should have a 1-year contract with all your SaaS clients. And then from a valuation perspective of these companies, you're really trying to increase the ARR, right? And
Mm-hmm.
so if you're going month to month, there's some schools of thought that say you cannot count that from an accounting perspective towards
Yep.
your ARR because
Mm-hmm.
it's not an annual contract, right? It's a month to month contract, and the customers could get out whenever they want. So, especially under GAAP, you want those contracts to be at least 1 year, so you could count them towards your ARR and get a higher multiple for the company.
Okay. All right. So that's actually that's a good point to talk more in detail related to valuation. SaaS companies, all of them, they are looking for like quick multi-billion-dollar valuation. And how do you? And you touched upon one of the pricing models that would determine the valuation. What other factors are there that would help these companies become like a $0 to $100 million valuation?
Yeah. So I think you have to grow even in this market pretty quickly and significantly. And uh, from a sales perspective, it can't be you're pushing your product out to the market. The market has to be pulling your product in. And you feel that it's hard to describe exactly what that is, but there has to be some pull in the market and almost like you've entered into a tornado uh, in the marketplace. So with the product, and that's when you know you found product market fit when there's so many leads coming in that you don't know how to handle them, or you know your over capacity at leads that are coming in, whether it be through your website or email or whatever the channel might be. And so that's a great indication that you are well along the path of product market fit. And it's not a destination, it's certainly a journey to find product market fit. And but the deeper that you are in it, the better that it is, because you continuously kind of evolve as you put out new products as a startup or as a SaaS business to continuously find product market fit for those products. But to go back to your question around valuation, you really have to do what's called the triple, triple, double, double. And maybe sometimes the triple, triple, double, double, double. So in the first 5 years of the company, the first year you have to triple revenue. So it may take a while to get to that $1 million, $1.5 million ARR mark. But you got to get there. It might take 2-3 years to claw your way there. A lot of founder-based selling, but you get there. But once you get to that mark, you have to triple the revenue. So if you've got $1.5 million in revenue, that next year you got to get to $4.5 million in revenue. The year after that, you have to
This is
triple it
at the
again
startup point, or are you saying it every year?
every year. So
Okay.
that you triple revenue in the first year after you reach anywhere from 1 million to $1.5 million of revenue. Okay.
Okay.
So let's say we'll keep things on the low end for this example at $1 million in revenue. Once you've reached that $1 million, and it may take you 2 years, even 3, to get to $1 million in revenue. There's a company called UiPath. They do a lot of RPA, robotic process automation, and integration technology. It took them 10 years to get to $1 million, but now they're one of the most valuable companies in SaaS, and you know they're doing extremely well. So it could take a long time to get to $1 million in revenue. But once you reach that $1 million, you know, for venture capitalists to really be interested in the firm, you know, you could go raise a seed round at that point, or maybe even call it a Series A. But then you have to triple your revenue, right? And so then at that point, you go and you know get to $3 million. Year 2, you got to get to $9 million. So that's a pretty big jump to get from 3 to 9. And we're talking the low end of the scale there. You get to $9 million, you could raise another round and at $100 million in terms of the valuation, or somewhere around there. Public markets today, I think Meritech Capital just released a study where I think the average or the mean public company SaaS is trading at about 6 or 7 times revenue, which is pretty low considering the peaks that we were at in 2021. But that's because interest rates are much higher than they used to be, and technology companies are very sensitive, especially public ones, for interest rates, to interest rates. Then you will have to double the size of the company from there. So you may go raise another round, maybe raise a Series A or B at that point in time, and then go double the size of the company. So if you're at around $9 or $10 million in revenue, the next year you're going to have to double that to 20, then again double it to 40, and then again double it to 80. And if you can follow that trajectory of growth, then it's pretty clear that in 5 years you'll have that unicorn that everybody wants to accomplish. But it's not easy. It's very difficult to do. You have to have an extremely strong product. And frankly, you probably need to come out with more than one product to do that. Have to maybe have a suite of products that are related to each other. And then you have to have very strong go-to-market and sales execution that can scale that quickly in the marketplace and understands the dynamic and what needs to happen from the sales perspective to go in 5 years from $3 million in sales to $80 million in sales. And the amount of scale that requires and skill that requires is pretty significant. So in the traditional B2B SaaS enterprise software market, that's the traditional path that you have to go down to go get that unicorn status. Now there's some consumer-oriented software products or consumer-oriented technologies that, or they're in a hot space like AI, where they're very low on revenue and they go get around at $1 billion, right? Or something like that. Those are the ones you hear about in the news a lot. And those are very rare, in the market. You might get an ex-engineer from OpenAI that decides to go start a company, and because they were an engineer at OpenAI and took 3 people with them, they were able to raise around at $1 billion or something like that, right? And they're very rare. And 2, at some point, they're going to have the revenue catch up to the valuation. So essentially, a lot of times, it's like a mortgage. Eventually, you're going to have to pay the piper for that valuation. And now it becomes more difficult to do that because you have to do all the hard work in the company post a very high round. The good news is you now have the cash to do it. So, but the bad news is you also now have the cash to do it.
Okay. All right. No, that's definitely that you brought in about like an ideal situation in terms of you get to 1 million, and then from 1 billion you get to like 70, 80 million.
Yeah.
The transformation that is happening in the company at that time, and for the founder to from starting something in their garage and taking it to like $80 billion in revenue. How does that transformation happen for the founder of the company?
Yeah. The team, it's really about the team. The founder, a lot of founders tend to be technical founders that really understand the product and understand how to build a product, or are great product folks. But the business side of the equation, the sales, the marketing, the go-to-market, even the finance and HR aren't areas that they have typically had expertise in, right? But those are the areas that you really need to scale. You have to get the product right, but you also have to scale those other areas. Personally, I believe that's why folks like Larry Ellison, he certainly did a great job with Oracle and grew the company
Mm-hmm.
significantly and was CEO for a very long amount of time. But I think he enjoys working on product the most, and that's why he went from CEO to CTO a while ago and had Safra Katz take over as CEO. And because I think he just enjoys product, and I think a lot of founders find themselves in that position. And the key is really surround yourself with the best you can find for those roles and things that you necessarily aren't great at or don't want to do even as a founder. Because as a founder, you could dilute yourself if you're trying to learn how to sell, for example, or learn how to manage HR, or learn the details and intricacies that are associated with gap financials. And but you're a product guy or product girl,
Mm-hmm.
and so focus on what you do well and double down is my thoughts on what you do well, and bring in the people that are equally as good as you are, if not better, in their respective areas, and trust those people to do the jobs that they were brought in to do. And you will
Mm-hmm.
know if there's any shortcoming in those areas. You have to manage the organization intelligently, have the right checks and balances within the organization, no matter what department or area that is in. And those departments are going to have to collaborate with each other. For example, sales and marketing are two departments that have to be very cohesive in terms of how they work together within an organization. So you'll know if the marketing person, for example, isn't delivering enough leads, sales will, make a lot of noise and tell you they're not hitting their number because there's not enough leads for marketing. And but if the close rate on the sales side isn't what it needs to be, you'll hear from marketing that we're not hitting the number despite delivering a significant amount of leads to sales. And so you'll hear that throughout the organization and be able to determine, are these people, where you need to tweak and make adjustments within the organization. But I think the technical founder of a company, at least my philosophy and my belief is, you want a technical founder in the company that's focused on product. That's the ideal scenario. And if they have the business acumen to grow or have it prior, like let's say they were a founder of a company in the past,
Mm-hmm.
learned all these things, and then now this is their second or third rodeo, then they should be able to scale and go from there. But I think you want to keep the founder as the CEO of the company, the technical founder, as long as you possibly can, because you don't want to create disruption, you don't want to create issues as well. But in scenarios where that might not be a fit, Atlassian is a great example. Everybody in the software development world is familiar with Jira and that software. They have two CEOs. One is more product based and sets the vision for the product, and the other is more on the business side of the company. Salesforce for a very long time had two CEOs as well, and ran the company that way. So it doesn't mean that if there is another leader that comes about, it doesn't mean that you have to push out the original technical founder, but
Mm-hmm.
you bifurcate the duties that are in the company and have them both run the company together and take it to where it needs to go.
Okay, all right. You touched upon the on the innovation side. I'm gonna ask you a personal question. You have established multiple companies and on the technology side and whatnot, and your companies were most of them. They were like right now you are with a company that is worldwide, that is in the need. When it comes to innovation, where do you get your inspiration from? Because you are not following a
Uh,
trend, you are setting the trend.
right, without question. So I think that comes from uh, domain expertise, in really being close to what's happening in your customers. So as you develop a large organization or become part of a large organization, you tend to get further and further away from the front lines and the customer. And but as you have strong domain expertise and worked in a specific industry or in a specific area, you understand that area. And then as you go talk to customers, they will uncover challenges that they're having and obstacles that they're encountering. And because of your domain expertise and the experience that you have that's unique relative to theirs, when you bring it all together, there should be something that inspires you to come up with an idea to, at a minimum, evolve the way that the customer does things today, right? The evolution, the faster horse, to go back to the analogy that we drew earlier. Now, the hard part about developing the faster horse is other folks are probably developing that as well, or it's more difficult to maintain a moat and lead around a faster horse, unless you've come up with some kind of disruptive technology to make that horse extremely fast, right? And so to really cut above the edge or above the market. To develop, but every once in a while, someone comes around and has an idea that is disruptive enough to really upend the entire industry or domain that they operate in, or at least a specific area or niche of it. And those are the ones that, you know, are the big swings, frankly. And sometimes because it takes a lot of cultural change and change management to adopt those technologies at times, they fail. The risk of them failing is bigger than the risk of them succeeding. But if you are able to succeed in that, think the BlackBerry and the iPhone is a great example of that. It's game over. You've developed the next great company.
Yeah. All right. Related to we talked about the growth path. When people are establishing SaaS-based companies, should they have an exit strategy from the get-go? And what does that
Yeah.
look like?
Mm-hmm. So I think you build a company, whether it's a SaaS company or a services company or any, frankly, type of company, in mind that you're going to build it indefinitely. And because you don't know what's going to happen in the market, the general market may not be right for an exit at the time that you predict an exit. And you might not know what's going to happen from an execution perspective inside the company and inside the market that you're operating in at a more micro level. So I think, generally speaking, you should go into a company wanting to build it to be a great company, whether it's a big one or a small one or a medium-sized one. In terms of your vision, it should be a great company at what it does, right? And then the exit opportunity will come. But if you now, and again, this is just a personal perspective. I've seen folks go out and build a company specifically for it to be acquired a couple of years later. And there's nothing wrong with that, especially, you know, if you're like running a family office or doing private equity, and that's your thesis behind maybe acquiring a few companies, bringing them together, creating some synergies, and then exiting those companies. There's nothing wrong with that, but it's not the business that I'm in, and nor is it what I enjoy doing, right? And so even though when I founded Maverick, I exited 3.5 years after it was founded, I didn't go into Maverick for an exit. I actually wanted to build a great marketing services company,
Mm-hmm.
and that did all types of different marketing services. But I ended up getting these offers for the company at a time in the marketplace that I knew was uh, was somewhat frothy. It was in 2021. We were in the middle of zero interest rate policy, and the valuations for companies were at an all-time high.
Mm-hmm.
So, and I was questioning whether or not we'd ever see an environment like that again, at least for 10 years. So I thought that would be the right time to do it, especially giving it to the hands of, some of the folks that bought it. I thought that they were the perfect, buyers for the company. So I think at the end of the day, there's nothing wrong with starting a business, knowing what your exit is, but the true intent should be to build a great business,
Mm-hmm.
and the exits will naturally come. And a lot of times, if you keep your head down and just build a great business, the exit will be bigger than anything you ever imagined.
Okay. All right. And so let's change the topic a little. On you talked about the Maverick, which was a service-based company, and you exited successfully exited from it in 3.5 years. And when we think about like, especially these days with the AI and everything, a marketing company is like every other person is starting one because it's just so easy to do.
Mhm.
So when you look at the service-based company, what are the elements that we did talk about in detail related to SaaS product based companies? What are the critical elements that you that you have to have in a service-based company to actually grow it to a level like you grew Maverick in 3.5 years? What were the
Yeah,
core ingredients in that?
yeah. So I think a lot of times in services-based companies and even in SaaS companies, and you need this, uh, they're founded by a lot of folks that have technical expertise, but may not have a lot of go-to-market expertise, right, on the sales and marketing side. So they may know a specific technology or know many technologies and be very adept technically, uh, but don't necessarily know how to sell that and bring it to market. Most of my career was on the sales and marketing side. So I knew which areas and which technologies were growing really fast and where to kind of hitch my wagon. But I also understood how to bring that to market, uh, and what needed to be done in order to bring it to market and sell a lot in a relatively short period of time. At Maverick, we did well into seven figures of revenue, or bookings, I should say, within the first 3 months of starting the company. And so it kind of exploded right out the gate. And then the second is, there's the saying, the riches are in the niches. And a lot of times there's folks that are great at horizontal technology stacks. So they might do, AI one day and then custom software development the next day, and, services here the next day, and, maybe offshore a lot of that. So they believe that their price point is lower, and, but really do a lot of different technologies. And because they want to service a market, as much of the market that they can. I don't believe that's the right approach for a services firm in the early days. Uh, the riches are in the niches. So find one niche, find a vertical niche, whether that's one technology or one area, If it's a large technology, let's say, for example, a lot of folks are building services around cloud migrations, and whether it be Azure, AWS, or Google, and those are pretty big markets. Find a niche within that niche. So if you're an AWS shop or a Google shop or an Azure shop, uh, find a specific use case or a specific vertical within AWS migrations that you're doing and working on, and then go execute on that and take that to market better than anybody else. And that market in and of itself will be big enough to go build a pretty good firm, maybe 10, 20, $30 million firm, and then extend from there, right? So now you've built, let's say it's an AWS migration firm that is focusing on a specific vertical within AWS migration, let's say financial services. And within financial services, let's say banking, right? Like, we are the best banking cloud migration firm on AWS, right? You could build a pretty significant, business on that. At 20 to 30 million in revenue, you're looking at a 60 to $90 million exit, somewhere around there, maybe $50 million. But let's say you want to build on top of that. So then you move into wealth management, another vertical within that that's adjacent, similar, but different. And go build another $5 million, $10 million business on top of that. And then before you know it, you continue to extend the business by lumping these niches that are related to each other. And now you've become, built enough relationships at AWS where you haven't diluted yourself. They're bringing you into deals. You're trying to catch the momentum that's associated with that, because it could be absolutely significant if they start bringing you into deals in the example that we're using. And you're known as the expert in that area. But that's the advice that I would give to anyone that is building a services firm, is go find a very specific niche that is a somewhat large market and go be the best at doing that. For Maverick, it was, Salesforce, because I came from the marketing world. And so we chose Salesforce as the technology we're going to adopt. But Salesforce, just like AWS and a lot of folks doing cloud migrations today, is very broad. And they have several products. They've made significant number of acquisitions. So even though we did several Salesforce products, the one that we really went in on was Marketing Cloud. And so we went deep into Marketing Cloud, and then we picked two verticals within Marketing Cloud that we said we're going to do those verticals and understand those verticals better than anybody else. So if you're going into communications media tech or RCG, those two verticals are going to be retail consumer goods. Those two verticals are going to be the verticals that Maverick does extremely well for Marketing Cloud. And we signed a significant amount of customers in that area. Salesforce caught wind of it, and they started bringing us into deals there. And we would go, we didn't go directly into the large enterprise deals. We actually started in what Salesforce calls the commercial business, which is kind of mid-market business in SMB. And then once we had success there, we went into the large enterprise businesses associated with those verticals.
Okay. All right. You brought in a good point in it, two elements. One is that for a technology-based company, it's easier to identify the niche. For a service-based company, it becomes difficult sometimes for the founder to identify the niche, because they think that, okay, they can do this or that or 10 different things. But it's very important to know that what you said, that the riches are in the niches. So identify the niche that you can service, and that's how you gain the market share. Related to the entering into the market for a service-based company, many folks that I have talked to, they always feel that they have to start small. They cannot just go at the enterprise level and start providing services to that. What are your thoughts related to it?
It really depends on, and I'm assuming you're talking about the services, right? Part of the
Services,
business.
yes, services work.
Yeah. It depends what the service is, to be quite candid. Um, the sales cycle for SMB can be as difficult, if not more difficult, a lot of times than the enterprise market. The other thing is in the enterprise market, um, because of the scale, there's a whole new set of issues that are there that aren't in SMB.
Hmm.
For example, if you're a SMB, and we'll use the example of cloud migrations because I know a lot of AMCAB members may have businesses, at least some
Yep.
of the ones that I talk to around cloud migration. Um, the In SMB, you could just go spin up an AWS instance if you're starting a new business and start using AWS. But if you're a large enterprise, you've got all this legacy AS400 and God knows what else, and you've got to migrate that and optimize that code first, and then take it to the cloud, right? And so there's a whole level of issues and complexity associated with large enterprise that you just don't have in SMB. I would start if I was in that business, frankly, in enterprise. I wouldn't start in SMB or maybe even mid
Yeah.
market. And because that's where uh, they have the challenges and the obstacles
Hmm.
to really build a business on top of that. And you're not going into these businesses fresh. It's not like a lot of the folks that are building these businesses are going in without really understanding what it takes to go be an expert in the business. They're already an expert in the business, have
Hmm.
probably done it in market in some way, shape, or form, and now are trying to build it as a company. And so that's what I would do. Frankly, there's a lot of AI. If I were building a services business all over again from scratch today, there's a lot of AI vendors that are and data vendors that are growing extremely fast today and need services partners to go and implement and work on their deals. That's an area that I would certainly explore. And because they're growing so fast, you could go straight into the enterprise very quickly and close some big deals in the first year or two.
Okay, all right. There's so many nuggets that I see in this talk. So thank you very much, Binod, for spending this time with us and sharing your knowledge and expertise. Last question for you as we are coming up to an hour. What are the what are the things that you know now that you wish you would knew when you were starting your businesses? And what piece of advice would you give to fellow entrepreneurs?
Yeah. The first thing, so to answer the first part of your question, I would say uh, get an outsourced bookkeeper to give some very practical advice in the early days and make sure they keep your financials up to gap from day one. And don't do cash basis accounting, accrual based accounting. Go get yourself a QuickBooks account and make sure that your financials are in order day one. There's so many businesses that I look at investing in where the first thing I've got to do is bring in a financial person to clean up their books so we understand what's going on with the business because it's not gap based accounting. So go do that. It makes life a lot easier for any investors. or potentially any exit down the road. The worst thing, one of the worst things you could do is be 5 years or 8 years into a business and ready to exit, and the first few years of that business had books that weren't necessarily the cleanest. So because then even though they're not looking at them, they're probably looking at the last 3 years, but they'll question then the validity of the last 3 years, because they're based, each year's based on closing the cash of the previous year. And then, so that I would do that. I would say the other thing that I would tell myself uh, is never lose the passion that you have for the business on day one, and keep that going, uh, and have a concerted effort to keep that passion going for the business. Because there's, especially in the early days of a business, even if you bring in a lot of customers and millions of dollars of business, you're going to have to, in a services business, use that to go deliver um, the to the customer, right? You're going to have to hire people and then build a customer for those folks, and then eventually you'll get the money. And so don't do it for the money, do it for the passion, uh, and the money will come. So those are probably the two things that I would tell myself in the early days of building a business. And the advice that I would give uh, to entrepreneurs. The other piece of advice that I would give to entrepreneurs in today's market, which is different than it was 3 years ago, is on top of the passion, on top of the vision that you have to have, know that you have to build in most situations. Forget the press releases that you see in the news that you see of these multi-billion-dollar venture capital rounds and all that. I mean, those are very unique
Mhm.
and very rare. Uh, that's why they're in the news, is because they are unique and rare. Now, if you have the opportunity to go do something like that, um, great, go do it, right? And I think you shouldn't prevent yourself from doing that. But 9 out of 10 times, and maybe more than 9 out of 10 times, you have to build a solid business, a business that's making money and growing fast at the same time. A lot of people like to use the rule of 40 as a general rule for the metrics on how a business should be run. That means you take your EBITDA, your profit,
Mhm.
should and you add that to your growth rate. So your EBITDA percentage and your growth rate, combine those two, it should equal 40. So, and that's a general rule of running a good business. I actually think in today's environment, it's the rule of 50 or 60. And so you have to actually increase your growth rates and increase your profitability, because we're not in a zero interest rate environment anymore. So that's the very practical advice that I would give entrepreneurs that are growing companies in today's business, is really, minimally follow the rule of 50 when you combine your EBITDA percentage and your growth rate percentage.
All right. Thank you. And thank you again, Bernard, and thank you for being a member at MCOP and sharing your experiences and knowledge with other members. What's the best way to reach you if somebody wants like to talk to you further?
Sure. I'm always available for AMCOB members. I think it's a great community that you've built, Kashif, and I thank you very much for making me a part of this community. It's absolutely fantastic, and I am happy to add value any way that I can. The best way to reach me is over email. It's BELHARAZIN77
All right. Thank you so much, Bernard. And thank you again for being a part of this journey at MCOP and being you are one of the businesses that everybody aspired to be in terms of how to run a business, how to grow a business over a very short period of time. So thank you for sharing your knowledge and skill set and your expertise, and looking forward to further conversations later.
Thank you, Kashif. You have a wonderful day.
You too. Thank you.